This is Insight with Haslinda Amin, and today we're live in Shanghai from JPMorgan's annual Global China Summit. We've had some great conversations here already, but the best is yet to come. In a couple of minutes, we'll be joined by co-head of Global Banking and EMEA CEO Filippo Gori, and in about 30 minutes, we speak with the CEO himself, Jamie Dimon, joining us exclusively just a couple of days after warning that markets are being too complacent about risks ranging from trade and credit spreads to geopolitics. Welcome to Insight. Fears about the ballooning U.S. deficit are unsettling global markets. The emphasis remains on President Trump's tax cuts, with limited progress so far on any meaningful spending cuts. And as the budget negotiations unfold in Washington as we speak, investors are focusing with greater urgency on the funding challenges. The Sell America theme is back in focus, with the bond market sending a warning to Trump and Congress as U.S. 30-year Treasury yields breach 5%. Bloomberg's Avril Hong is in Singapore with more. The yields back in focus, Avril.
Absolutely, Haas. I mean, this has been a recurring theme this week, the concerns about the U.S. fiscal health as this debate rages on the budget deficit, on taxation, on spending. And we saw it played out following the Moody's downgrade earlier in the week. More recently, it's about that weak U.S. 20-year Treasury auction, really weak demand for it. And that is what prompted the curve steepening overnight in the U.S., where we saw the 10 years and above, we saw those moves upwards of 10 basis points. Treasuries on the long end mostly holding those losses even in the Asia session. Now, Haas, you mentioned it's that Sell America theme, flip the board. You talk about the dollar moves as well. That is really the undercurrent when you look at Asia FX gains. Of late, remember earlier in the month, we saw those really sharp moves on the Taiwan dollar, since learning that the Taiwan Central Bank saw this as part of its strategy. And in the background, we have all these discussions from these various economies with the US, whether the FX figures into the equation. A report that the South Korean won's direction was discussed was enough to send the South Korean won rallying to 6-month highs just a day ago. A bit of a reversal now, but also what we're hearing between Cato and Besant about how they're going to let the markets decide on the exchange rate and determine that, and that they did not discuss FX levels. It's really a trend of a weaker dollar underpinning all these moves, Haas.
That's right, the weakness in the dollar front and center. Trump says no currency manipulation. Avril Hong, thank you so much for that. Well, all the Trump-induced volatility in the dollar, inflated Treasury yields, and debt fears are pushing big U.S. companies, including Pfizer and Alphabet, to Europe to borrow money. Data compiled by Bloomberg show that so-called reverse Yankee deals reach a record this year at a total value so far of around $94 billion. Let's get straight to our exclusive guest. Filippo Gori leads JPMorgan's newly formed Global Banking Division, which combined its commercial, corporate and investment banking businesses. He also heads the bank's Europe, Middle East and Africa operations. Good to see you again.
Good to be back.
Second time this year.
Yes,
my luck here.
Yeah.
We talk about reverse Yankees, how American companies are now looking to Europe to raise funds, presumably because of the risks in the U.S. How are you looking at this?
I think corporates looks at the way they can raise funds globally in the most efficient manner. So ultimately, I think for many of them, it's when you swap it back into dollars, what is the cheaper way to do it. And probably right now there is, for a variety of markets dislocation, there is an opportunity to issue what you call reverse Yankee in Europe, and they're taking the opportunity, they're maximizing the opportunity. What we are seeing also, which is interesting, is at the beginning of the year, there was definitely more of a European interest into the US. When you and I met in Davos, there was probably the peak of the euphoria in that context. And right now, you actually see a little bit of the opposite trend. US companies that are thinking, you know what, Europe has still a cheaper valuation, notwithstanding the weaker dollar, and therefore there is a little bit more of an interest from the US into European names for some potential M&A deals.
You got to wonder how feasible the movements are, considering that if you take a look at Brussels, how it's cut the Eurozone's GDP forecast. There's trepidation, there are questions about growth.
I mean, there is always questions about growth when it comes to Europe, and as a European, it pains me because it's always, oh, Europe is. You always have the feeling that we are lagging behind the rest of the world. The reality is, my impression, the European economies have been incredibly resilient in what has been a complicated geopolitical environment. The ECB is cutting rates, probably will be below 2%, 1.75% by the end of Q3 this year. But the economies have been remarkable. Most of the problems with Europe, or some of the problems with Europe, come from a very codified and stringent regulatory environment that often does not allow the flexibility that would be required when you have external shocks. Tariffs is an example where Europe will take longer to adjust to the environment compared to what we have seen the UK doing, or other countries around the world, including China, have been dealing with this administration. But I remain optimist as a European, as a proud European. I remain optimist for the continent.
People are talking about diversification, and Europe might just benefit from that.
I think there is definitely an element of that.
Give us a sense of the kind of inflows you're anticipating. Give us a sense of the kind of deals you might be looking out for.
So, when we talk about Europe, often we tend to bunch all the countries together. In reality, you are dealing with many different dynamics. The UK has its own dynamics. All continental Europe has its own dynamics. Then you have Central and Eastern Europe, which is dealing with different set of circumstances. The Middle East and Africa. Each one of them operate in different ways. And it's difficult to just say, oh, there is a story that is common across all of these countries. There are some secular trends. And on one side, Africa, you have the urbanization and demographics that are playing in their favor. You have the Middle East moment that you are feeling definitely right now. The global South narrative is definitely being positive for the Middle East. And you have all continental Europe, which is trying to implement what is fundamental, which is the Draghi report. In our world, Capital Markets Union is probably the single most important thing that would be required to implement many of the suggestions from the Draghi report.
You talk about the Draghi report. It also talks about the need for banking consolidation. Yes. We've seen some activity in that space.
Yeah.
How are you assessing that?
So, historically, JPMorgan's side of the family has always been the bank of the central governments and the bank of the banks across the world. That's kind of our historical DNA. Therefore, we tend to discuss and advise many of our clients across the world in that context. Europe has been lagging pan-regional consolidations because the regulatory environment doesn't make it easy. You see some attempts to it, but most often than not, it's only happening when the acquirer has already a license in the other country because it makes sense to upstream deposits and so on and so forth. Otherwise, it is still largely a domestic set of consolidation. In my own country, Italy, right now, it's probably it's in the spotlight in that context. Europe would definitely welcome from having larger banks, because banking, financial services in general, has become a game of scale. Think about the investments that you are required to have every year in technology, in cyber, and so on and so forth. So having larger European banks will help propel that growth that in the continent, in the old continent, has been a little bit anemic over the last few years.
I want to talk about the Middle East because we know that out of Doha, we heard that JPMorgan will be hiring more in that region.
Yes.
Where are the opportunities? Which sectors in particular?
Look, the Middle East is benefiting, as I was mentioning earlier, from this global south narrative. For a variety of reasons, it feels that right now it's the Middle East moment. We have an historical presence over there, and this year we are celebrating our 90th anniversary in Saudi. And therefore, we are building and we are investing further into that part of the world in all the relative countries, because you feel that there is a sense of capital moving there, opportunities moving there, and there is a change in the economic landscape and restructuring of some of the economies that is taking place. Saudi first among all of them, that is making it very exciting. So it feels that right now it's the time of the Middle East.
And that excitement is being felt by your rivals as well, right?
Absolutely.
UBS, Goldman Sachs are also looking to expand. So what's the strategy? How are you looking to grow? How are you looking to scale in the Middle East?
Across all the products, across all the lines of business. For us, every time we go into a country, the business model is always relatively simple. We want to be there to help global clients doing business in the countries, and similarly, local clients who want to do business offshore. It's our strength is creating those capital connections, which is the theme of our 21st Global China Summit, create those capital connections in the countries wherever we operate. And that's for the narrative. So we are hiring, whether it's bankers, whether it's colleagues in payments, whether it's an AWM, asset and wealth management. That's what we're doing across the board.
Filippo, how much of the excitement on the Middle East was prompted by President Trump's visit to the region? He talked about trillions of dollars of deals being signed.
I think the narrative was already there. I've been going to the Middle East frequently over the last 6 months. You could feel the excitement already in the middle of last year. It has been propelled by a variety of different reasons, but it was already there before.
Let's talk about Saudi Arabia in particular.
Yeah.
Trump said that it accounted for about $600 billion of investments. How are you looking at Saudi Arabia in particular? We take a look at how it's been the provider of capital for so many years.
And now
it's been reversed.
Yes.
How are you looking at that?
So it's interesting because for decades Saudi Arabia was the provider of capital globally, and now because of the changes that they are being performed to its economy and the investments in infrastructure, is actually is borrowing capital, which makes it interesting. And the changes that you have seen over the last decade are really remarkable. More than 50% of our colleagues in Riyadh are actually female colleagues, which 10 years ago would not even been possible. So there is an enormous set of changes. You can perceive them when you are there, and therefore that's where I think the excitement is coming from.
Okay, so your priorities in the next 12 months?
Across global banking or across...
Both.
Global banking, I think finalizing the integration of the 3 lines of business that you mentioned earlier. It's a long process that will be done by the end of the year. In Europe, it's definitely be there and support the clients in every country and jurisdiction where we have presence, looking at the Middle East, looking at Sub-Saharan Africa too, and just be there for our clients. Ultimately, that's our job, is there to support them through good times and bad times.
Filippo, always a pleasure. Thanks for joining us. Filippo Gori, co-head of Global Banking and EMEA CEO at JPMorgan. Now, still ahead, JPMorgan CEO Jamie Dimon sounding the warning this week of a market complacency in the face of inflation, to credit, as well as geopolitics.
My own view is where people feel pretty good because you haven't seen an effect of tariffs. The market came down 10%, it's back up 10%. I think that's an extraordinary amount of complacency.
So are markets setting themselves up for a big disappointment? We'll ask that and more in an exclusive conversation with Jamie Dimon coming up in just a few minutes. You don't want to miss that. This is Bloomberg. Welcome back. You're watching Insight, coming to you live from JPMorgan's annual Global China Summit here in Shanghai. Now, a White House senior AI advisor, Sriram Krishnan, says the U.S. will continue efforts to keep the advanced technology out of China's hands. But he's brushed off calls from NVIDIA chief Jensen Huang to ease restrictions on chip exports to Beijing.
We obviously have huge respect for Jensen. I was with him and several other founders and CEOs in the Middle East last week. When it comes to, I think it's important to make a distinction between advanced semiconductors being used inside China and everywhere else. When it comes to inside China, I do think there is still bipartisan and broad concern about what can happen to these GPUs when they're physically inside, because a lot of these are obviously dual use. They can be used for a broad range of applications. And we've tried to kind of thread the needle when it comes to export regulation. But one of the things to point out is I think Jensen is right on a couple of these items. The first is our previous export controls have failed from the Biden regime. So if those export controls had worked, we would not be looking at DeepSeek coming out the first week of President Trump's being in office, which basically kind of skirted around a lot of our export controls. So the Biden regime did not enforce those export controls correctly, and we are taking measures to stop that. But again, it is important to distinguish between GPUs inside China to the rest of the world. And when it comes to the rest of the world, we want American AI stack, starting from the GPUs to the models to everything on top. We want our companies, a lot of them obviously, sitting very, very close to where you are now in Silicon Valley, to go diffuse around the world. And I think on that, Jensen and I and us are in violent agreement.
You raise an interesting point that many technologists or just technology company founders in the Bay Area particularly make to me, which is, why even bother with the infrastructure build out in the Middle East? Why not retain the full stack and capacity here in America? Both not just from a national security point of view, but just the market, have all of the workload availability here on domestic soil?
Mm-hmm. I'm happy you asked that, because I saw this come up on X a couple of times. And here's what I would say. The first is, going back to the first thing I said, as a part of these deals, every bit of investment that goes into the Middle East, into infrastructure, is going to be matched in the United States. So if we have a lead, we're going to continue having that lead, and we're going full throttle on build, baby, build, as what maybe the president would say, in terms of making sure we have enough infrastructure and enough capacity. But on the other hand, you have to think about the fact that these and other countries in the world are our allies. They are resource rich, they have ambitions, they want to use American tech. What do you think winds up happening if we basically say, hey, we can't do business with you, go look elsewhere? They're going to go look elsewhere.
Okay.
We would much rather have them locked in to the American stack for years and decades. And what that would represent to the founders and CEOs watching this is an opportunity for partnerships, an opportunity for market expansion, rather than a market which is locked to an adversary.
That was White House senior AI advisor Sriram Krishnan speaking to Bloomberg's very own Ed Ludlow. And the simmering U.S.-China tensions are also a factor at the Beyond Expo in Macau. Our reporter Annabelle Droulers is there and joins us now. Belle, what's your sense of the mood on the ground?
Yeah, well, Has, I can tell you that US-China tensions are factoring into conversations here at Beyond the Expo that's just kicked off in Macau overnight. I mean, some of it's in quite obvious ways. For instance, I'm standing here at the iFlyTech booth. That was actually one of the first companies that was sanctioned during Trump's initial term in office. It was also one of the early frontrunners in the AI space. But generally, this is also a hardware event. And last night, for instance, we also heard from a panel of 4 different entrepreneurs in China that are all operating pretty major businesses, including in the transport, smartphone place, and they were all saying the same thing, which is that the price pressures and the competition within China is just so intense that they do need to find export markets abroad, and that's really difficult when you're facing things like the de minimis exemptions and also tariffs. But it's not just that focus on US-China tensions. I mean, here there's also a lot of really funky, cool technology that's on display. For instance, this company here is integrating AI into how you end up feeding your pet. We're seeing AI that's also being used in a lot of different ways, for instance, in food technology, sports technology, lots of different applications. Also in the humanoid robot space, because we know, for instance, that China's been a real front runner in the humanoids space. Lots of policy support, investments over several decades, and now you're really starting to see the results of that. So this, for instance, this robot here that we're taking a look at, it's from Engine AI. This is one of the best known robot startups in the Chinese robotics industry. So this one here, I'm told, has the capacity to do a front flip. This one here in particular, maybe not coded to do that, but I'm told it can also shake my hand. So let's just see if that, can we shake my hand? There we go. All right, we made it work. I think it can also do a dance as well. So this, again, a really big focus has on humanoid robots, and there's lots of different stalls where you can see them here today.
Took a little bit of time, but the handshake did come, Belle. We know that Huawei is one company at the center of US-China chip tensions. What's going on there?
Yeah, that's right. I mean, Huawei is really a company that's been caught in the crosshairs between the US and China for a long time now, but it's something that's really ratcheted up over the past couple of weeks, and this really revolves around this new warning that the US put out. So essentially, last week or the week before, the US put out a statement saying that any company anywhere in the world that's using Huawei's technology could be in violation of US export rules. Now, Beijing, we know they pushed back on this, and they actually said that this action from the US could risk undermining all the progress that was made in Geneva on the trade talk front. But at the same time, the US hasn't really changed their stance so much. Yes, they removed that wording anywhere in the world, but it stays in place. So now China has come out with their response to this overnight, and they're actually threatening legal action for any company that complies with this US call to not use Huawei technology. So they're saying that any company could be in breach of what's called the anti-sanctions or anti-foreign sanctions law if they do proceed with assisting the US. So certainly something that, again, risks that progress on trade talks, even as we see conversations that continue, for instance, between China's vice foreign minister meeting yesterday with the new US ambassador to China, David Perdue, but also other conversations, including earlier this week between the PBOC governor and also the former US Treasury Secretary. But Huawei, to note, of course, one of the different companies that are exhibiting here today at the Beyond Expo in Macau.
Belle, you got to wonder how this might all play out.
Yeah, that's right. I mean, certainly these trade tensions, you know, and you see that really being factored in, again, as I said, into a lot of different conversations here, in a lot of ways that it's sort of being sliced and diced. I think, as I said, for the companies that are exhibiting here, one of their primary concerns is when you've got those competitive pressures at home, how do you continue to find new export markets? And countries are really becoming aware of this overcapacity concern, and so it does become an issue for businesses here that are trying to find these new international markets. But again, you know, it's something that dialogue is continuing. It doesn't remove really some of the major sticking points, and semiconductors is issue number one.
Great stuff, Belle. Bloomberg's tech reporter Annabelle Droulers in Macau. And still to come on the show, our exclusive interview with JPMorgan CEO Jamie Dimon is coming right up. We'll talk about President Trump's big, beautiful tax cut bill and why he's so worried about geopolitical risks. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight, coming to you live from JPMorgan's annual Global China Summit here in Shanghai. Now, House Speaker Mike Johnson and Republican leaders are pushing a new version of President Trump's massive tax cut bill to win over warring party factions. The latest version includes a higher limit on deductions to state as well as local taxes, known as SALT, as well as speeding up cuts to medical and ending Biden-era clean energy tax breaks. It's not yet clear if the changes are enough to get the bill through the House. Bond markets, meanwhile, pushing back against Trump's tax cut plan over concerns it will add trillions to the U.S. deficit. Yields on the 30-year Treasury trading above 5%, close to a two-decade high. Treasuries were already under pressure after Moody's last week stripped the U.S. of its top credit rate. Let's bring in Jamie Dimon, Chairman and CEO of JPMorgan, joining us exclusive here at the bank's Global China Summit. Jamie, good to have you with us.
Thank you. Happy to be here.
You've always talked about how there's been extraordinary complacency, that markets are not pricing in the risks. With what we saw in yields overnight, is that a reflection of risks being priced in?
Yeah. So when I talk about that kind of complacency, I'm talking about the asset price in the United States, and it's a long list of things. It's QE, it's fiscal deficits, it's global fiscal deficits, it's potential of the trade wars, it's these huge complex geopolitical situation, and I look at all of those probably not being properly priced into the marketplace. But we don't know what's going to happen. So I saw last night's reaction. I don't worry about one-day move in bond markets. So
you don't worry about one day, but when you take a look at yields, they are at higher levels than they were before Liberation Day. I mean, we talked about how 30's higher, and some are talking about 10's getting to 5's, 30's getting to 7%.
Yeah.
How are you assessing that? I mean, how high do yields have to go before they reach breaking point?
Yeah, I don't know the answer to that. No, we assess, the way we run the company is we prepare for a full range of outcomes, regardless of what you think. I just think there's a chance that you'll have stagflation. So I'm not saying it's going to happen. I don't want the reader to say he's predicting stagflation. I'm not. But we have to be prepared for something like that. I think the global fiscal deficits are inflationary. I think the remilitarization of the world is inflationary. The restructuring of trade is inflationary, and this is not all an American thing. And the infrastructure needs are inflationary. And now you have offsets. You have oil prices down quite a bit, which is quite deflationary. But with all those things taking place, yeah, you may be surprised. And I love to read economic history. So you can look at models. I think it's also very important to look what happened in '72 and '74 and '80 and '82 and 1990. Surprises happen, and most economists and most models don't pick those inflection points. And those inflection points are often driven by geopolitical complexity, things you don't necessarily know. And we had the oil crisis in '74. So we just want to be prepared for everything, so we can continue to serve our clients through thick or thin.
You talk about how concerned you are about debt, and of course, add to that the tax bill that's being voted tonight, they say. That's going to make it a lot worse. Your take on that?
Yeah, well, the United States is running the largest trade deficit that we've ever had in peacetime, almost 7% of GDP. And how the tax bill gets done, they'll probably add a little bit to that. I still think it's better that we get certainty around tax bill. I'd rather get that done, but I do think at one point Americans are going to attack its deficit problem. So do a lot of Republicans think that, so do a lot of Democrats think that. And that attack isn't just raising taxes, it's having proper policies around incentives and growing business. And I just got back from Europe last week, and everyone there is talking about growing the economies, getting more investment, reducing the regulatory environment that slows down growth, keeping everything safe for food, water, banks, et cetera. But I think governments have to do a better job at that. And so pro-growth, pro-business is a very good thing, and hopefully that can offset some of the extra spending one day.
As we said, it is a higher yield environment, and you have said before that we could see some sort of rebellion in markets around the world. Is that still a possibility?
Yeah,
How might that look like?
Yeah, so I would not call it a high yield environment. I mean, if you look at economic history, rates have been far higher than this, and they surprise people over time. And like I said, I think a lot of the longer-term trends have inflationary attributes to them. And so the other thing for your person on TV, credit spreads are low. So you can have two things go against you, which is credit spreads gap out and rates are going up. And so we'll see how it plays out. So I don't want to guess how it plays out. I'm on the cautious side. I'm a little skeptical that we're going to have kind of just an ongoing soft landing here.
Let's turn our attention to China, where we are.
Yeah.
Is it still a priority market? Because even as your rivals de-risked from China, pulled back, you actually boosted your resources here. How are you looking at China in the next 12, 24 months?
Yeah, so we invest for the long run. So I don't look at, we're not buying and selling the stock when you say invest the next 12 or 4 months. And look at this conference, we have, when I first, it's 21 years. The first one we had a couple hundred people here. Now we've got almost 3,000 people here. I think 1,300 companies, investors from 33 countries. We do research now, I think, on 400 Chinese companies. We're a long-term investor here. Yes, there's all these other issues cause consternation, but we have to deal with the world that we have, not the world we want, and we'll continue to grow. We cover, I think the number is 1,700 multinationals around the world in China. And these are, clients of ours from Latin America, from Europe, et cetera. And we take a lot of Chinese companies around the world. We have Mandarin-speaking folks in Brazil who speak Portuguese and Mandarin so that we can facilitate commerce between Brazil and China. So long-term investors concerned about, the current environment. But I think hopefully it will all sort out, but we're not going to pull back. I mean, I gathered the story that came out there. Somehow we're cutting back in China. That's completely false. But we understand we're going to have some political pressure until all these things are resolved.
So you're looking at China as one of the priority markets to invest in the next 12 months, perhaps. Is there consensus within the leadership that this is the place to be? You talk about taking a longer-term view.
Yeah. The consensus is that companies are going to be doing business here. There are going to be some adjustments because of the trade negotiations. But I don't think the American government wants to leave China. And we just had our Secretary of Treasury meet with the authorities here, and they're talking about having a good relationship. I'm glad that they engaged, talked about what we can do and improve things. I hope they have a second round and a third round and a fourth round, and I'm hopeful they'll end up in a good place. And
in terms of China's growth?
But if you look at China, I mean, China's, go way back. They've done an enormous job over the last 20 years lifting up their people. That doesn't mean I personally agree with everything they did. I'm a full-throated, red-blooded American patriot, capitalist, but I understand that they're doing what they can to lift up their country. And here, I've seen their cars and their AI and they've done a pretty good job, and we should look at America and say, okay, we're going to have to compete too. And so I'll leave foreign policy to the experts in the government. So.
Companies get caught up in the crosshairs of the U.S.-China trade tensions. I think JPMorgan got caught up in the CATL listing in Hong Kong. You maintained your position.
Yeah.
Why?
Because, first of all, a foreign policy is set by the government. It's not set by JPMorgan. And the government did not sanction CATL. There are people who didn't want us to do it for a bunch of reasons, and they may have somewhat legitimate reasons, but I think the government should decide what to do, so we aren't going to do that. If they had told us we couldn't, I would salute and move on. I would have no choice. And so there are legitimate issues around national security. So if you went through all those issues, I understand that. We don't think it really applied to this particular thing. We and other investment banks did a lot of due diligence around all the issues that people raised, and I'm sure I'll be criticized about that too. But if we thought it was wrong, we wouldn't do it. So.
Do you expect more pressure?
But we're getting pressure from governments everywhere about just about everything. We're not green enough. We finance so many oil and gas companies. We get it from mayors and governors. I understand that. We try to answer them all rationally and serve our client. If there are legitimate complaints, we try to adjust ourselves, and every now and then there are, and we make an adjustment.
It is a volatile relationship, right? Yeah. And that volatility is expected to persist. Do you see JPMorgan and your peers continue to be pressured by the government to perhaps move away from deals or business with Chinese companies?
I have to be very careful. Both governments have export controls, import controls, investment controls. I do think those things will take place and they'll morph over time, and we'll adjust to them.
What's your strategy in Asia, bearing in mind that there's been so much pressure on the Chinese government and people are increasingly talking about diversification? How are you looking at your business in Asia?
Yeah, so we look at, every country has its own population, its own education, its own culture, its own growth, its own natural resources, a lack of them, its own we pretty much invest in all of them. And all these countries, we network with them. So we're banking companies here around the world. You're from Singapore. We bank Singapore. We bank Singaporean countries, and they go all around the world. So almost every one of the countries is kind of growing. And so that's how we do it. We look at each one. We don't go in and out. We don't look at investing in a country like a stock, like we think Vietnam's going to have a bad year and therefore we put. No, we look at how they're growing their population, how they're growing their companies, how they're growing their economy. And then, of course, in some cases, we simply follow clients already into those countries. So a lot of companies that we bank from America want us to be in more countries so they can consolidate more of their payment systems. And then we build those things, and we enter new countries for that reason sometimes. So my view is that's going to be going on for the rest of my life and for many years after that. And there'll be ups and downs due to trade and the economy.
I guess the premise of the question is Trump's tariffs and the trade war. Is that influencing, shaping your investment decisions and where you grow?
Not really and not directly. So like I said, I'm an American patriot. And I think there are legitimate national security issues. I think America could do a better job focusing on our own national security issues. Like, think of, we should never get all of our rare earths from one country, much less a country who might be an adversary. That was a mistake we made. It should be fixed. So there are a lot of legitimate issues that have to be dealt with, but the government is doing that. We talk to them. We just announced a Center for Geopolitics, and we help other companies look at their supply chains, their cyber resiliency, all of those things. And I think at the end of the day, it'll be okay. So even President Trump has been out there saying he likes President Xi. He wants open trade. He just wants to fix the trade he thinks is unfair. And if it's unfair, it should be fixed.
You talked about your Center for Geopolitics. Let's talk about that. What's the thinking behind it? How will it help navigate? How would it help your clients, customers navigate?
So first of all, we do it for ourselves. So you can look at JPMorgan. We've always extensively analyzed every country, every potential risk. We look at hundreds of risks to make sure we can handle. JPMorgan's got to survive just about anything, and we try to make sure we do that. This Center for Politics is both for us, but it's also to educate our clients, because we get asked. A lot of clients are asking us all the time about what should we do about this country? What should we do about this? How do you look at risk? So we just help them look at various risks they have, and so this is kind of an outgoing. I always remind people, we actually help clients in AI, cyber, geopolitical risks, governance, in addition to like raising capital and M&A and things for them, and just kind of another service we provide.
And of course, that center is in the Middle East. Is there a sense that the role of the region in the world is growing exponentially?
Which region?
Middle East.
Well, I think it's growing exponentially, and like we've been in Saudi Arabia for 80 years plus. So yeah, it has wealth, it has sophistication, and I think it's had leadership that wants to do a good job at trying to grow their economies and diversify their economies a little bit.
Is this the moment for the Middle East?
I hope so. I mean, look, the Middle East is a very complex place. And I think, the terrorism is terrible. But I do think that you've seen a complete sea change in how they view. I think they want peace there. I think all the big players in the Middle East actually want peace. I'm talking about Saudi Arabia, UAE, Qatar, Egypt. And I think it would be in their interest to bring real long-lasting peace, including for Israel and hopefully eventually for the Palestinian people.
Of course, we're talking about the Middle East on the back of Trump's successful trip to the region.
Yeah.
Do you think that trip marks a turning point in relations? If you take a look at the amount of deals that were...
It might. I couldn't evaluate that quite yet. I do think, if you go back to Trump 1, that I do think there was a sea change with Trump 1 and how they were looking at Saudi Arabia, et cetera. I think Saudi Arabia's changed a lot. I mean, it's dramatically different from when I first started going there. Like, women can drive cars and go to schools and don't necessarily have to wear burqas, et cetera.
Jamie, I'd be remiss not to ask you about the Fed. Given the higher yield environment, which you say it's not, but it is still higher than what it was before.
But it can go higher.
Will it go higher, and also will it force the Fed's hand?
Yes. I mean, there's always a notion that somehow the Fed is omnipotent and can do whatever it wants, and they do set short-term rates, but they also have to follow the facts. So they raised rates because inflation went up. and they can't control it. Even today, trillions of dollars of these bonds are sold every day. That's done by investors around the world. They cannot control all of that. Foreigners own $35 trillion of U.S. financial tradable assets. And so, they have to react to reality, in which and that's not a criticism, they say they're data dependent, but they have to wait and see exactly what happens and then do the appropriate thing.
But the thing is, their reality is different from the reality you have in mind. If you take a look at what Neil Kashkari said, he said the U.S. economy is on solid footing. And some other Fed officials have said that in terms of Fed policy, it is in a very sweet spot. So their reality is quite different.
I think, I don't agree we're in a sweet spot, okay? And I think you have to separate two things. The economy has been doing well. All the facts, we have effectively been in a soft landing. That does not tell you what the future is going to be. To worry about the future, you have to look at all the things that affect the future, kind of work your way back to the current day. And I've already mentioned huge deficits. We haven't finished quantitative tightening yet. There are huge geopolitical issues. There are these inflationary factors out there. And they have to react to all of that. So I think they're doing the right thing to kind of wait and see before they decide. And,
one final question, and I promise this is the final question.
Okay.
The dollar, right? Usually when you have a higher yield environment, the dollar gets a boost, but it's the other way around. How are you reading into dollar weakness?
Yeah, well, like I said, foreigners own $35 trillion of U.S. securities. The United States still is the most prosperous, innovative nation on the planet. That's not going to change. But I think it might be reasonable people looking at, and also asset prices are high. So if you go around the world, you look at stock prices in the U.S. or up here, PE ratios or other parts of the world are much lower. So people legitimately say, well, maybe a little bit less dollar assets and a little bit more of that. So you may see some kind of adjustment. I think at the end of the day, the important thing for America is that we do the right things to grow our own economy, and that includes affordable housing and pro-business and innovation and growth and R&D and all those things. That's the important thing. I don't worry that much about short-term fluctuations in the dollar, but I do understand that people might be reducing dollar assets today a little bit.
Coming from a patriot. Jamie Dimon, thank you so much for joining us. Jamie Dimon, Chairman and CEO at JPMorgan. Plenty more ahead. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight, coming to you live from JPMorgan's annual Global China Summit here in Shanghai. We're doing a check on cryptocurrencies, Bitcoin in particular, surpassing that 111,000 level for the first time, heading towards another record with traders increasingly bullish on its prospects. Of course, that's on the back of that stablecoin bill in the U.S. Senate, fueling hopes of greater regulatory clarity for crypto operators. Now let's dig deeper into the latest moves on crypto with Bloomberg MLI strategist Mary Nicola in Singapore. Mary, what a run for Bitcoin.
Yeah, absolutely. And I think it's just the fact that you have this bill going through in Congress is a really important factor in terms of legitimizing and making it clearer for investors in terms of with the government really supporting it. So I think the fact that you have this and the support behind it, the government support behind it, because that's really what was missing. It felt like for a lot of investors that it was a bit of the Wild West in terms of the lack of the backing there. And now with it, it just legitimizes it a little bit more.
Well, I guess the question is whether that momentum is sustainable from here, Mary.
Yeah, a lot of it is there's going to be a lot of pushback, right? And Bitcoin hasn't had an easy and steady rise because if we see what's happened, a few months ago, not too long ago, we were talking about it really coming off from where it was. And then, of course, when you look at where Bitcoin has come, it's come a long way. And a lot of it has to do with risk appetite and how especially retail investors are feeling. So I think a lot of it, too, will have to come through in terms of what are we seeing in the equity markets as well that is going to support Bitcoin, and then what is risk sentiment overall that will anchor Bitcoin and the steady rise. So for now, yes, you get that push from the bill, but if you want the increase to continue, you're going to need a little bit more oomph there.
So I guess the follow-up question to that is whether other smaller coins will benefit as well. We know Bitcoin up for 5 straight days in a row, up 3%. Is there a catch-up play for the rest?
Yeah, absolutely. I think there's no reason why they shouldn't, especially because if the bill looks at the focus of the crypto in general, and the administration has made it very clear from the beginning that they were supportive of the crypto market, and that's really one of the big Trump traits to begin with after the elections. And I think if this catalyst here is just going to take that forward. But again, a lot of it is going to depend on sentiment. We've seen a lot of ebbs and flows when it comes to Bitcoin, and a lot of nerves and volatility. I mean, one of the big things about Bitcoin and about cryptocurrencies is that comes along with it is really high volatility, more so than equities and more so than any other assets. So of course, if we're going to see higher highs, you're going to have to endure a lot of volatility in the meantime.
Mary, one eye on cryptocurrencies, the other eye on the big and beautiful, the tax bill that will be voted on, they say, tonight. How do you see yields playing to this?
Yeah, I think it's a really precarious environment for yields right now and for bonds overall, and even the impact and the potential filter through onto equities. So we've seen that yields are not, bond vigilantes are not happy with how things are unfolding, because if you look at the bill, the focus is more on tax cuts than cutting back spending. And that's a real issue, especially if you've got a budget deficit nearing 7% of GDP, and of course concerns about fiscal sustainability as a result, as the budget deficit just balloons. And of course, the investors are not going to be supporting a bond market that is seeing fiscal profligacy and governments enduring such fiscal profligacy. So I think what we're going to end up seeing is that if the budget gets passed, you're going to see more stress on the bond market, and of course that can filter into the equity markets as well, because higher yields will essentially, especially for the tech industry and for growth stocks, will not be good.
And of course, we heard from Jamie Dimon just earlier that he expects yields to be higher from here. The big question we are asking is when 10 would get to 5. It's just a matter of when, isn't it?
Absolutely. We've seen the trajectory on the 30-year continues to push higher. We've seen the fact that the markets are uncomfortable with what's happening on the budget side. And of course, if this gets passed, that's just the trigger. And that's going to bring it just to 5% and then push it even higher, especially if it looks like this budget is likely to pass. So of course, it's going to go through the House, then it has to go through the Senate. So the bill, it still has a long way to go, but in its current form, it's going to propagate lots of nerves and issue a lot of stress into the bond markets.
Watch this space. Mary Nicola, Bloomberg MLive strategist, thank you so much for that. Before we go, now here's a look at our show tomorrow. We'll have more from the JPMorgan Global China Summit here in Shanghai. Cohen Group Senior Counselor Craig Allen will be joining us on the latest tensions between Washington and Beijing. Plus, we'll talk augmented reality technology with Rocket. That is it for Insight. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.